Your market news now. A surprise interest rate hike in Canada gave investors their second reminder of the week that the surge in global interest rates isn't done yet. Asian markets struggled and the cautious mood continued in Europe as London's FTSE, Germany's DAX and the French CAC gradually crawled higher after starting in the red. The Fed, the European Central Bank as well as the Bank of Japan all have interest rate decisions next week. Economists polled by Reuters expect that the U.S. Federal Reserve will not raise interest rates at its June 13th to the 14th meeting, but a significant minority expects at least one more increase in 2023. For more, we are joined by Tato Mashego, who is from Sanlam Private Wealth. So, Tato, thank you so much for your time. Let's check in on market sentiment given the surprise Bank of Canada interest rate hike.
Good afternoon, Anastasia. As you rightly said, the market has taken the surprise 25 pip hike by the Canadian Central Bank with a bit of unease. You will recall that Canada was the first major central bank to pause in March after the rate hike cycle that we saw last year. And so them reinitiating by adding a hike, and they stated that inflation remains persistently stubborn, above 2%, may suggest that we will see further hiking going forward. Of course, Australia earlier in the week also hiked. So some are speculating that the Fed may, or we may have a split decision, most likely, with a small chance of a hike next week, but definitely people expecting a hike in July and a pause next week. But one never knows given what we've seen from Australia and Canada this week. And obviously it's had quite a negative effect on risky assets today.
On that note, how important is the CPI data that we are expecting next week just before that Fed meeting? How important is it?
I think it's very important, given that Chair Powell has stated that they will be taking a data-driven approach to their decisions going forward, or at least in the interim period. And so all major data points are going to have an impact on their decision-making, as they don't have an overall glide path or an overall, I suppose, feel, whether one was to call it hawkish or dovish at the moment. And we saw obviously last week's US jobs data showing that wage growth remained a bit high, even though unemployment ticked up. So that obviously is suggesting some persistence in inflation. So yes, I think the CPI data will be quite important. If it's very negative, then one cannot rule out a hike even next week, and Fed funds futures are pricing in a small possibility of that happening. But if the data shows further moderation, then the pause, which is the base case, is most likely to happen for June, I think.
There's some economists, at least when we talk about things from a SAB perspective, who think that we are at the end of the interest rate hiking cycle, or at least close to it. If you had the luxury of being in that room during the MPC committee meeting, what would you be advocating for going into the next SAB meeting?
Well, I think the decision in the last meeting, despite the subsequent depreciation of the currency, was most likely the right decision. Of course, prior to the tail risks of diplomatic and geopolitical tensions, I believe that the SAB would most likely have, looked to pause. But obviously, once you started to see a run-up in the currency, and obviously permutations for importing inflation going forward, I think the hiking was correct. Of course, we did see foreigners selling off, and I think expectations from foreign investors were that South Africa could still achieve a growth rate of between 0.5 and 1% for the year. Obviously, that has come down now to flat across the entire market. So going forward, I think a pause is definitely the base case, and I would be surprised if we saw anything other than a pause in the next meeting. That's what one would advocate for, as we see how certain macro factors do unfold, especially when one considers, for instance, energy over the winter months and some other factors. So I think that's probably what the market is pricing in at the moment. One would be surprised if there was any further hawkishness given how consumers have responded so far.